Hello and welcome to Moneyline. This is Matt McCall. Thanks for joining me here again. It is Friday, October 16th. You know, we don't even have a big show this week. We have a huge show. We're talking about the market pullback, big rally today. We're going to be talking about how to play the vaccine that could be up before the end of the year, and three sectors that you would never think of are hitting all-time highs, and I have a stock idea for every single one of them. All this and more coming up on Moneyline.
The buck starts here. Moneyline with Matt McCall.
All right, folks, thanks once again. This is Matt McCall, and you're watching Moneyline or listening to Moneyline if you're on your phone or other device, maybe getting ready for your iPhone 12 that's coming out. Apple have announced that earlier this week. But it is Friday, October 16th. It's unbelievable how fast this year is going. I mean, it's probably a good thing. Let's get it over with and maybe start again in 2021. All that being said, it's been an amazing year for business. It's been an amazing year for people in the stock market, for our subscribers, for our clients. So I don't want that to end anytime soon. But boy, it's been a wild ride here. Right now, it is about 10:45 or so on Friday morning here East Coast, live in Baltimore. The S&P is up about 30 points, about 0.85%. We have the Dow up over 300 points, over 1.1%. And then the NASDAQ kind of in line with the S&P up 0.8%, just under 100 points. And then the Russell 2000, which is a small cap index, is flat. It's been really weird as of late because when the market pulls back recently, the small caps have been doing pretty well. So we're seeing this really kind of divergence between the overall market and what the small cap's doing. But I will say we are having a special event next Wednesday, I believe, or Tuesday the 20th, and it's all about small caps. And I'm going to be talking about that. And I am a huge fan of looking for opportunities in small cap stocks. And I just had a very long discussion with our head copywriter and our CEO about small caps and private investing, which we're launching a new private investing product in a couple of weeks. And just about how the perception of old Wall Street, let's call it, for some reason, they think the smaller the company, the more risky. So we had a really great discussion about it. And what it came down to was that the way of thinking is, I'd rather just go into blue chips. It's the best way to go, less risky. No, it's actually riskier because if you're in the market for a long period of time, you want to take some risk. You're going to have losers. You think about the VC Silicon Valley people. Their win rates maybe 10% if they're lucky. They have a lot of losers. Anybody who's ever become wealthy investing has to take some risk. It's just part of life. It's just how you get there. It's why you leverage yourself to buy properties or do whatever it is. Like it's just part of being successful. Not successful, that's the wrong word. Being wealthy in business. You have to leverage yourself. It's something I learned very early on, and I still don't think I'm leveraged enough because I still come from a mindset of if you have money, don't lose it because we didn't have any. So I still have that mindset, and I'm always trying to break that. So I want to help you break that too. It is okay to take some risk. It's okay to have some losers because these winners will outpace that over time. I'm telling you. I'll get more into that next week and as we continue to go along. But for now, let's get into the show. I put this show together yesterday and I had written down, the market. I want to touch on the market here real quick. But I had market pullback because we had the pullback in September, then we rallied and we pulled back the last 2 days. And yesterday morning, I was up super early for some odd reason, and I had on CNBC, I think it was like the World Exchange or something. It was, it might have been like people from Europe that were doing it. And then Brian Sullivan, who used to work at Fox the same time I did, I mean, the guy's a joker. He's terrible at his job. I mean, the information they spread is just such BS. As a person, I'm not going to comment on it, but what they do on air is just terrible. And I mean, they were freaking out because the market was down 1%. And then they had one of their correspondents from London come on and say that basically they're going to shut down all of London and potentially all of the UK again for 2 weeks. No, they're not, folks. No, they're not. They've been talking about that since COVID started. They're not shutting it down for 2 weeks. They're not shutting the entire country down. UK's not going to do it. I'm telling you. So what was ironic about the whole thing is they're freaking people out, scaring them. We're only down 1%. Do you realize that we rallied in the S&P over 10% in the last 2.5 weeks? A 1% pullback after a day of pulling back 0.5%? Who cares? That is normal. It's actually not a bad thing. It's what I call a healthy pullback. And then, of course, the Dow's down 1% pre-market. The Dow closed down 0.1%. What they forgot to tell you was yesterday, the S&P retail index hit an all-time high. The Dow transports hit an all-time high. The housing ETF hit an all-time high. They forgot about that. All they freaking talked about was UK potentially shutting down, London shutting down, shutting everything down. Excuse me, going into a lockdown. It's such BS. But I gotta tell you, as I'm getting ready, as I'm working, doing this, and I have this on in the background, you start thinking to yourself, and the more you hear it, maybe you start believing it. Such a disservice to investors. It just irritates me. So let's talk about this COVID second wave for a minute. Again, I'm not a doctor. I'm not an expert. I'm just looking at numbers here. So in my opinion, this is pure opinion. I'm going to piss off half the people out there. I don't think the shutdown worked very well the first time. I think it put a lot of people out of work, and I think it put a lot of people on the streets. I see it here in Baltimore. I was in New York last week. It was too many people on the streets. It sucks. And I think a lot of shutdown had to do with that. The cases have gone up, yes. But if you look at Worldometers, which pulls the numbers that everybody gets behind, the trend of deaths in the U.S. continue to be down since July. So for over 3 months, the trend is down. There's no debating that. A lot more cases, but a lot less deaths. Because at first it got into the nursing homes and these people completely screwed up and let other people come in, and it wiped out a lot of senior population. And now we know more how it spreads. We're wearing masks. We're being smart about it, which is great. Hopefully we still wash our hands. I do. I have 2 huge bottles of sanitizer and a big Sandy cloth that is enough to clean this entire building right behind the camera here. So we are very, very cognizant of that. And my mask is right here. So we're doing what we can. But again, I don't think we have another shutdown. So don't worry about that. Also, the International Air Travel Association, IATA, they claim that only 44 people have been affected since March on airplanes. Well, yesterday, the numbers show that through the TSA traveler throughput, that over the last week, about 800 to 850,000 people are traveling per day. So let's go back to March. What is that? That's March is 7 months ago. If I'm looking at the chart here, how many people have flown since then? Tens of millions of people, and 44 in a plane. I've flown a lot. You folks know, I talked about it. I was on a train last week to New York. I got to tell you, because people are being so diligent and wearing masks, sitting apart, social distancing, washing hands, being very just what you're supposed to do during this, it's almost safest on a plane or a train. It's unbelievable. So that, again, I don't see people stopping air travel because it's not a place that you're catching it, as long as you're smart about it. You're seeing a huge spike in colleges, professional sports, college sports. I'm a huge sports fan, as you all know, getting hit. Nick Saban, the coach of Alabama, and the AD down in Alabama, the athletic director, both have it right now. I know I read Nick Saban's asymptomatic. I think he's 69 years old, somewhere around there. So he's in that age group that I have to be a little more careful. But hopefully, I'm sure he's in great shape. He looks like he's in good shape, and hopefully gets well soon, as well as everybody else who has it. But again, you're seeing younger people get it, not being hospitalized. No, deaths are falling. So I don't see any type of shutdown happening again. Excuse me, in this country. This is allergies. Don't worry. In this country or UK or any other country that concerns me right now. That's topic number 2. One was the market, and back to that real quick. Buy pullbacks, folks. I've been saying this. I'm going to continue to say it until I turn blue in the face. That's what you want to do. We bought a company or stock for some of our clients at Penn Financial yesterday. Obviously, I'm not telling you what it is, but very unique play. Recent IPO in a sector, I may call it retail. It's kind of quasi-retail, but bought on pullbacks. The stock has pulled back quite a bit, and we're buying on pullbacks for long term. I think it's an 8x in the next 5 years. 8x. And this isn't some small cap company. It's worth $5 billion. So, man, there's just so much opportunity out there. I'm going to be buying more today. So much opportunity out there. So buy pullbacks, folks. In quality companies. Don't just buy anything. Quality companies. One more topic here, kind of why I continue to be bullish is the election's, 2.5 weeks away. I think we get a stimulus deal done. I know Trump came out one day and said there's no way we're getting one done. I think within 12 hours he said, I'm open to it. Steve Mnuchin has been open to it. Nancy Pelosi says blames Republicans. Republicans blame Nancy Pelosi. Who the hell knows? But I do believe that it would help Trump's case if he does do one, and the fact that he has the power to basically get it through. I think something will get done, and that will be a huge boost to the stock market heading into the election. So I think this rally continues. I think we hit all-time highs in the major indices before the election. Stay long, stay strong, and buy any weakness in any volatility we have leading up to the election, folks. All right, so a couple things else I want to talk about. The fun part we're going to do last, and that's talking about 3 areas hitting new all-time highs, why they're hitting highs, what this means for the economy, what it means for stock market, more importantly, what it means for you, and 3 stock ideas that go with that. And even more importantly, right before that, I'm going to talk about some stocks that are the secondary plays on COVID. But before we get there, 2 stock stories I want to talk about that are in the news recently and big news recently. And one is Fastly. You've probably heard about it. It was all over CNBC yesterday. I think the stock ended down about 30%. It's down another 3.5% today. The symbol is FSLY. Stock's fascinating because it's a software application play, but its largest customer is TikTok. So TikTok, we all know, is kind of the teenage thing where you make these weird videos. It's kind of like a very short video. I have no idea. I'm not even on Instagram or Facebook. I'm on Twitter, as many people know. You can follow me at Matthew McCall, 2 T's. But I don't do any other social media because it's just not for me. I got my Dunkin'. But TikTok's huge, and we know that President Trump came out and tried to ban it, did ban it. I don't even know from day to day what's going on with it. But Fastly came out and said because of that, they guided it a little bit lower. But they only guided like less than 10% lower for the quarter, and still said full year is going to be strong. Stock fell, like I just mentioned, we're down about 35% now. But from the intraday all-time high earlier this week, we are now down nearly 40%, 38, 39%. But for the year, the stock is still up, even with this pullback, losing nearly 40% of its value. The stock is still up over 300%. So this was a case of pricing imperfection. News came out, not as good as they expected, slightly less, and stock falls. To me, I follow the stock, but we never had any exposure to it. I don't know if I'd buy here. I hate catching falling knives. A lot of times it takes a few weeks or months to kind of get all the sellers out of it. But this is a stock that I would keep an eye on. That being said, another stock in this same realm is Akamai, AKAM. This stock's been around a long, long time. Looks pretty damn good here. It fell yesterday in news, but it's up today 1.3%, up $110 a share. I might look at that because I think that this company that has been around much longer, keep an eye on Akamai. I think you just look at what this company's done over the years to help get video out there online. Man, it's been a player for a long time. I don't see it going anywhere. It has a lot of huge contracts with some really big name companies. It's one to keep an eye on in that sector. And of course, the other very hot sector is EVs. And Workhorse, this has been one of my claim to fames this year. At one point, we were up over 1,000%. It's since pulled back a little bit, but we've locked huge gains already in it, selling 2/3 of it in 2 chunks, suggesting our subscribers sell. So it hit $30 a share twice. It hit it again earlier this week. And then the USPS, United States Postal Service, announced that their deal that could be over $8 billion for the next generation electric vehicle trucks that they're going to be putting out a contract with has been delayed. They said they're going to do it by the end of the year, but it's been delayed. It's supposed to be this week. As I mentioned on Tuesday, when it comes to the U.S. government, I am not surprised one iota that they pushed this back. I mean, they can't get their stuff together, so it doesn't surprise me. Does this mean now that Workhorse has less of a chance to get it? No. You're not seeing new players come in. They already got the bids already. They're in there. So to me, nothing has changed, just the fact that you're kind of kicking the can down the road a little bit. And this goes to why being patient in the market is so important. When we bought into Workhorse at 2 and change, it didn't go anywhere for months and then took off. We bought it in the beginning of May, went nowhere for about a month and a half, and then boom, next thing you know, we're up 10x. It took time. And that's actually pretty fast, but it takes time, folks. When you have a big trend like we had with Workhorse, this is a company I followed for over a year, and I did a lot of research on it. And people can say all they want about me, but I did my due diligence, and this is why you have to take some risk. It was a risky play, but you're seeing what's going on here. And they announced a $200 million secondary offering. They closed it this morning. They announced, I think it was about 4% notes that they did. And I have it right in front of me here, actually. I think it was 4% notes, and it was raised by institutional investors. So people, big money putting money into that. 4%, which is actually pretty damn low. And if they meet certain requirements, only paying 2.75% on it. Again, that's very low for a company like this. And then the holders have the option to convert to common stock at $35.29 a share, which the stock right now is at $28.84. So quite a bit above where it is right now. So that's great as well. So that's why I think the stock's up 2.5% on the news today. You're going to see a lot of volatility trading between now and the USPS deal. So keep an eye on it. But another stock in there I will mention, of course, Workhorse we still have for our subscribers, is NIO. And again, I don't share stocks we have for our Penn Financial Group clients all the time, but we have this one for some of our clients. And we recently bought at 18 and change. I think it was in September. I know it was in September. And we're already up over 50%. Stock's at 28, 26 right now. This thing's exploded. It got an upgrade just this week. And the numbers still look good. I think there's still more upside. Typically, there's times I might take a quick 50% in a month. I mean, that's tough to get in any market. But I still think there's much big upside with NIO. That being said, it's due for a pullback. It can't go straight up. So you have to realize, too, you can't go straight up. I mean, this stock has been up, I think, 4 or 5 straight days now. So, and huge volume. Pullback will happen. It may even happen today, even though we're still up about a little under 1% right now. So just wanted to mention those 2 stocks, what I felt on those, and Fastly, Akamai as well. 4 stocks have been in the news, just give you my view on them. So let's move on now to kind of what I call my secondary COVID plays, vaccine plays, that nobody else is talking about, folks. And the reason I want to talk about this is because nobody else is talking about it. So, and there's a lot more than what I'm going to share here, but I'm just going to go quickly through this. So a lot of the vaccines that are out there, everyone's a little different, but need to be kept at a very specific temperature, a cold temperature. So there could be a huge spike in demand for dry ice for transportation of the vaccine to where it needs to get. So there's a couple ways to look at this. You can look at some of the stocks that are some of the largest dry ice companies out there. The largest dry ice company in Europe is actually a company by the name of Yara. I think I'm pronouncing it correctly, Y-A-R-A. It does trade here as an ADR in the pink sheets. The symbol is Y-A-R-I-Y, Y-A-R-I-Y. Stocks at 1864, up about 1% today. It doesn't trade much. It traded about 500 shares today, so it doesn't trade much at all. But this is a big player in there. So if the vaccines that end up getting approved are ones that need to be kept cold, this could be something to keep an eye on. It's just one of those things to keep an eye on. Another player in there is Air Liquide, which again, based over in Europe, trades here as an ADR. AIQUY. Again, doesn't trade much. Only trade 9,200 shares today. It's at 31.65, about 1.6%. This stock actually looks fantastic where it is right now. When you think of dry ice, though, and that type of portion of the company, it's not going to be a big boom to this company because it is a big company already. But boy, it looks pretty damn good right here. So the chart looks great. Those are 2 to consider when you're playing dry ice. Again, you're not hearing about this on CNBC or Fox Business or any other BS network out there. You're not hearing it. What about transportation? I'm not going to give you my transportation play because I bought that for clients at Penn Financial. So I'm not going to give that one away. But there is a specific small company that trades here in the U.S. That is behind, that can help transport the medical, the vaccines, and already is in the medical industry, transporting medical-related products that must be kept at a certain temperature. It's important. I mean, this is something that's not just vaccines. It's happening already. Then what about the vials? I've talked about this before. Tons of vials are going to need it. One is West Pharmaceuticals, symbols WST. I mean, this stock has been on a tear. I remember a good friend of mine from high school, one of my best friends, he does some work with West Pharmaceuticals, and years ago, probably about 5 years ago, he's like, do me a favor, take a look at this stock. And I remember it's down around $40 a share. Now it's at 300 nearly. Man, what a run this stock has had. But this is a pharmaceutical supply company. Recently broke up to 300, pulled back to 280. It's at 293 and change today. Great company. It's run so much, though. It's tough to chase. It's up well over 100% since a low in March. But they could make a lot of things that are needed for the vaccines. It's one to keep an eye on. Another one is Thermo Fisher, TMO, another big company. Again, another stock that is, man, I cannot type today at all. Another stock that has done pretty well. And why can't I get the symbol up? What is, oh. Man, I got to tell you, my eyes, I think, are getting worse. I thought it was a T, it was a Y. Thermo Fisher, again, hitting a new all-time high today. You look back at this, and it's amazing. I mean, my goodness, you think about Thermo Fisher and the business model, and if it wasn't around COVID right now, if I tried to pitch you on buying Thermo Fisher now, or even years ago, they make instruments for labs and that type of stuff. They do softwares, regions, different instruments, chemical supplies, all that stuff behind the scenes, basically. I mean, you've heard of Thermo Fisher, I'm sure. I mean, it's a $183 billion company. But you look at it and you don't think overly exciting. However, last year earnings per share, $9.24 a share. By 2024, so in about 5 years, expected to be nearly 20, so more than double. So you're still seeing some growth with a company this size, which is fantastic. But if you look at what this company and this has done over the years, and you keep saying, I could have said to myself 5 years ago, it's probably had its run, it's too big now, it can't keep growing. And that sometimes will bite you, where, because if I look at the return here of the last 5 years of Thermo Fisher, the stock's up 275%. But if I go back 10 years, it's up 864%. If I max it out and I go back to the early 70s, and I say, we're going to invest in this kind of just boring business, but it's healthcare, up nearly 28,000%. So at that time, every $10,000 turns in about $2.8 million. It's a hell of an investment over time. So Thermo Fisher is one that's going to get some play out of this. Potentially Corning, because it makes glass for the vials. So Corning could be a winner in this as well. GLW is the symbol for Corning. Another company that has done really well in the last few months and recently breaking out near an all-time high, but has basically doubled since the low in March and April. So that's one to keep an eye on. And then the one that I own, and I don't usually share this, but I shared it before, is a large company in China called Shandong Pharmaceuticals, Shandong. And it trades overseas, so it doesn't have a typical symbol here. And I actually forget what the number is because they have such weird things over there, but I'll give it to you because you're going to ask. Of course, I can't spell at all today. So Shandong Pharmaceutical trades on the Shanghai Exchange, and its symbol there is in numbers. As many of you know, it's 600529, 600,529. And it is a just under $30 billion company based on yuan, so a couple $1 billion company here. Had a nice night last night, up 1.8%. It's since pulled back quite a bit. I think it looks actually fantastic here. So that's one that I have. That's my play on it. And look at that. I'm busting out of my shirt. Man, oh man. It means I should lay off the donuts in the morning, huh? Lonza, Lonza is the company name. Again, European company that trades here. LZAGY is a symbol. But this stock has gone bananas. And if you've heard of Lonza, you've heard of it for a good reason, because they are directly related to what's going on here with COVID, because they have a deal with AstraZeneca that they will produce their vaccine if it gets approved. Also is partnering up with Moderna. So Lonza is a very, very interesting play here. As far as the COVID, it's like, again, a secondary play, not your direct play on that. And this morning, Pfizer and BioNTech, which are working on a vaccine, And I think they're probably the furthest along right now. They came out and said that they could have emergency approval by the end of November for their vaccine. So Pfizer's up on that news about 2.4%. Pfizer symbol PFE. BioNTech, BNTX is up 2.4% on that news. Stock's up huge, up 50% in the last month, BioNTech. Still off the all-time high, just above 100 that we hit in July. This is a German company. But obviously, if that gets approved, it's going to have a much bigger effect on BioNTech than it would Pfizer, because it's a much smaller company and more direct effect on the bottom line. So those are just some quick plays. I'll probably spend more time in this as we get closer. But the reason I'm doing this and I'm sharing all these names, and again, none of these are recommendations. I'm just telling you ideas, and you do your own work. But the reason I'm doing this is that I want you to think different ways. Just having this conversation this morning, a light bulb went on in my head. It's something I've known for 20 years in this business, but we have to change our mindset of the way we think towards investing. It's not your grandfather's investing anymore. It's not about going into blue chips and just letting them go. That has burned a lot of people, whether it be AT&T. I saw it burn my family with Bethlehem Steel, a lot of Bethlehem Steel stock. That being said, a lot of people bought IBM way back in the day, 40 years ago, and they've made money and they've made fortunes off it, passed down from family. I believe in long-term investing, don't get me wrong. But what I'm saying here is you have to kind of look at these small caps, and just because IBM and worked back in the day, GE at one point made people a lot of money. Bethlehem Steel at one point made a lot of people a lot of money. It was in a Dow for goodness sake. Now, obviously, it's bankrupt. Doesn't exist. So you have to know when to get out as well, but it's very important to look in the early stages of getting in. And just because they're small does not mean they're riskier. And I just think we have to get that to their mindset. The other thing we have to remember is this is a basket approach. We're not putting all our bets on one. We're not moving it all on the red. We're not moving it all on to number 8. We're spreading our bets. So if we have a portfolio of 20 stocks, let's say, which is a lot of things, the way that I approach it at Penn Financial Group is, about 5% per stock or investment. That's 25 typically. We're spread out. It's what I called in my book, The Great Bull Market, which came out in 2009. I called it conversification. It's a mix between concentration and diversification. We are diversified through 25 stocks all over the board. But we are concentrated in trends I believe will be bigger in 5 to 10 years from now. Because I'm not going to be right with every trend. Some trends won't work. But if you're right with the trend, the odds of you picking a winner are extremely high. Imagine 10 years ago saying, I'm going to invest in a bunch of brick and mortar retailers. That trend was on its way down. You probably didn't do too well. The odds of you picking a big winner then, there was some winners in the last 10 years, but the odds of you picking a winner were low, right? Now think about 10 years ago, if you said, I'm going to pick a basket of stocks in e-commerce. Maybe you picked a pets.com 20 years ago and that didn't work out for you. But the odds of you picking a winner in e-commerce were multiples higher than you picking a winner in brick and mortar. And that's how we have to think. Think big. Okay, now let's get it fun here. We talked to a lot of stocks already, but last night, I was doing my wrap up, and I noticed 3 ETFs hitting all-time highs, and I thought to myself, I talked about this earlier, this is freaking nuts. We have home builder ETF hitting an all-time high, S&P retail ETF hitting an all-time high, and the transports hitting an all-time high. 3 very different sectors, folks, hitting all-time highs. Why don't we ever hear about this? I want you to watch whatever network it is that you like watching, and there's certain anchors. Listen, a lot of them are my friends. They're good people. But at the end of the day, you don't take your advice from them because they don't have skin in the game. They don't have money in the game. I have skin in the game. I tell you a lot of stuff we have. You see my newsletter. A lot of you are subscribers. You see what we do. Somebody asked again the other day why I don't invest my personal money in the stocks that we recommend in the newsletters. And I explained this 1,000 times, but I'll do it again. There's a tranche of my money that I invest from my stocks. Those don't mix with Penn Financial Group, which is the client's money I manage. And those don't mix with our several newsletters that we publish, from investment opportunities to early stage investor and everything in between. 3 different tranches. They don't. Legally, you can. I could do it. Ethically, it can get very gray, so I don't. And I don't know if I'm going to pick 3 genetic testing companies and put one in each, which one's going to be the best. But we're going to split it up. So people ask me that, so why, why is that? Well, because I don't want to have that gray area. I don't want everybody to question me. Listen, I'm doing my best for all 3 tranches. I want to make myself money. I want to make my subscribers money. I want to make my clients money. And I have skin in the game, because if my stock ideas for myself go down, I lose money penny for penny. If the stock ideas don't do well in the subscribers, you don't re-up. I get paid some of that money we bring in. I make less money. If I don't do well for my clients at Penn Financial Group, guess what? They're going to move their money elsewhere. I lose money. And life's not all about money, but we're in a money video here. This is a podcast about investing. So I'm investing in myself and my research by everything I'm doing here. So I do put my money where my mouth is. And again, CNBC anchors, Fox Business anchors, Bloomberg anchors, majority of the time they're not allowed to own stocks because they can talk about them on air. So they have no skin in the game. And I also love when they bring on guys and women from the New York Stock Exchange, like these traders, and tell you what to do. They're trading their own. They're not investors. They don't manage anybody's money. It's much different. Like me, if the stock market falls apart or if we lose money, it hits me 10 different ways. This is my livelihood. So I hope you get that. There's skin in the game here, man. And on top of that, I love this shit. This is what I do. If I wasn't doing this to pay the bills, I'd be doing it at night and not sleeping at all, or sleeping less than I already do. All right, let's get into it. So speaking of retail, I was talking about before, do you know retail sales hit a new all-time high? Just came out again this morning. And it's been now 5 straight months of new all-time highs. And that we've never had a recession where we've had at least 4 straight months of that. So that tells me we are moving out of recession right now, in my opinion. We also look at the increase, the increase here that we've seen. I'm looking at a chart, and I'll have it pull them up here for you, of going back to 2000, when we had recessions, how retails come down and they start moving back up at the end of recession. We're already at that new high. So this looks great. People are spending money. It's nuts. And that being said, there's still a record amount of money in savings and checkings account ready to be spent. Again, I'm not saying that we should be out there spending this much, but we do. And I feel like I've spent a lot less, but I'm ready to spend too. So XRT, which is the S&P Retail ETF, it's down 0.5% today, but yesterday hit an all-time high, So let's take a look at what makes up that ETF. And it's pretty fascinating when you look at it. It's not going to be your Macy's or your Nordstroms or your names that you're used to. I'm going to go through the top here. As I've been saying a lot before, this is kind of my quote today. It's not your grandfather's retail basket. And my grandfather's one of the greatest people in the world. And actually, if you've ever seen my tattoo here, let's see, I'm sure many of you have seen it before. This is actually my grandfather's handwriting and his initials, and it was his senior quote. So I'll tell everybody what this says. His senior quote in high school. I was on Ancestry.com a few years ago, a day before I was going to Europe for a month to backpack around. Couldn't sleep, and I got an email from Ancestry.com. And so I went through, and I saw a picture of my grandfather's senior yearbook, and his name was Owen, but everybody called him Mac from McCall. And people comment on it, which was kind of funny. The person commented, and they said, "You always know when Mac's around because there was a group of girls following behind," which I don't know if I ever viewed my grandfather as a ladies' man, but he was a good-looking individual. But him and I were very close, and his quote was, "Still water runs deep." And the moment I read it, I had tears in my eyes because he was very similar to me. You may not think it, but I'm quiet sometimes. I'm not quiet on air, but there's a lot going on underneath here, and he was very similar. He would talk your ear off for hours, and we always make fun of people like, "Oh, stuck in the corner of Owen, you can't get out." But he was also very quiet. He kept it all in. So very similar. I think there's a lot that's still inside. That's how I view the quote. So I got it tattooed here with his initials, and we took letters he'd written me and put the letters together to build it, and that's his actual handwriting. So that's what that is, and that's why that's on my arm, just so you all know. So not your grandfather's. So top stocks. GameStop, number one, believe it or not. People thought GameStop was dead. GME, GameStop's been rocking. Magnite, you probably never heard of. GPI, which is Group 1 Auto. Etsy, CarParts.com, Stance.com, Carvana. So it's a really not your unique, it's not your normal retail basket, but it's the S&P 500 retail. Because we're seeing where, again, I mentioned this before, brick and mortar that we think of is dead. It's not dead overall. I mean, there's still people are still going to go to stores. But how we think of it is dead. And online, obviously, has been big for a long time. So this shows, again, and I'm not a fan of ETFs, but I like the e-commerce. So I went through, and of course, I'm going to share one stock for every one of these ETFs that are breaking out with you today. And again, not recommendations, just I'm sharing a stock with you. One, we actually have this for subscribers, and I'm sharing this. And you know, don't be cheap. Go sign up for $99 for a year. I mean, it's worth it. Revolve Group, RVLV. This is an online kind of high-end fashion, women's line, you know, not teens, but, you know, millennials, I guess you call it millennials, but reasonable priced. So this company has been, it went public last year, ran up to $50, fell all the way down to single digits. Now it's back up to around $18.50, down a little bit today, down a few pennies. But Revolve, the last couple of years, the revenue went from 400 million, 500 million, 600 million. They had 600 million last year, looking to do a little over 600 million this year. Not much changing, obviously, because of what's going on. But by 2022, 860 million. So you're seeing a big, in the next 2 years, up, 26, so almost 50%. But earnings per share is what I like here. You know, last year, 64 cents. This year, 51. Again, seeing a dip, retail, that's not abnormal. But back up to 93 cents in 2 years from now. So at 93 cents, trading at 18.16, this stock is actually cheap in my opinion. I think this is easily a $30 stock from down here in the next 2 years, from 18, if not 40. So this looks great down here. And you're getting, this is something where, you know, you can buy it online and you could always send it back. I've seen the packages, but it's it's a niche area that people want to be fashion forward, and what that means is you want to wear something that's fashionable, especially for millennials. They like the way they look when they go out in public. You know, most people do, but definitely for a younger age. So this is one to keep an eye on. The other sector breaking out is home builders, and you know I've been telling you I love the home builders for a long damn time. It's actually down today, down 0.2%. ITB, iShares U.S. Home Construction ETF. And again, full disclosure, I own this for some Penn Financial clients, but we've owned it for many, many years. We're up huge, many, many years. I have not bought this recently at all. Let's look at top holdings here. D.R. Horton, DHI, Lennar, LEN, Lowe's, Home Improvement, LOW, Home Depot, Home Improvement, HD, Sherwin-Williams, SHW, you know, obviously Home Improvement as far as paints and that type of stuff. BLD, Top Build, which is going to be for builders. Masco, which is going to be for builders as well. MAS. So very, very unique, again, and very nicely diversified between home builders, home improvement stores, painting supplies, and then some of the supplies for actually the builders that they'll buy, Masco and Top Build as well. So one, you know, obviously I own it, love it. So I own it for clients, should say, and love it. So I found a stock for you here, again, that probably never heard of. It's a, and by the way, Revolve's a couple $1 billion. This one is called Jeld-Wen, J-E-L-D, J-E-L-D, Jeld-Wen, or I think that's how it's pronounced. Who the hell knows? Down about 1.2% today, but this is a maker of doors and windows. So as home construction is booming, as many of us know, there's a lot of home improvement going on, replacing doors, replacing windows. You're seeing a big demand here. Again, $2.5 billion company. And remember, mortgage rates hit an all-time low at 2.81% again this week. I mean, they're basically giving you money. Leverage, folks. Leverage, leverage, leverage. I know if you watched the Trump town hall last night, went back and forth between Trump and Biden. They went after him for his leveraging. And I don't know how much he's leveraged or what's true. I could care less. But I will say this. All successful, wealthy people have leveraged themselves. I'm not saying what he did is right, or I don't know anything about his numbers. I don't care. I'm not even looking into it. But I will say this. Successful people leverage. When I buy a home, I try to put down the least amount as possible. And I explained this last night. If you buy $1 million is a nice big round number. If you buy $1 million home and you can swindle putting down 5%, that's $50,000. And say over the next couple of years it goes up 50% the house from 1 to 1.5, and you sell. And again, just using round numbers, your profit's $500,000. Taking out no fees, your profit's $500,000, and you invested 50. That's 10 times your investment. If you put down 20%, 200,000. Put down 200,000. You still make $500,000 because you set at 1.5, but you're only making 150% instead of 10x. So that's a big difference. Plus, you have an extra $150 wrapped up in there that you could be doing other things with. So leverage, folks. Leverage. It's good if it's done well, like most things in life. So Jeld-Wen, $2.5 billion company, doors, windows. Last year did about $4.29 billion in sales. By 2022, 4.7. So not huge as far as revenue, but earnings per share looking to increase from $1.37 this year to $2.15 by 2022. Forward price, the sales ratio 0.58, very, very cheap. Forward PE ratio 14.7, very, very cheap. One to keep an eye on. If you believe in housing, I think it's one to keep an eye on. And the last sector is the transportation, IYT, breaking out to a new all-time high. Again, down today. A lot of them that were up yesterday, down today, 1.1%. It's down today. And the markets have turned around and turned since I started the show. Boy, I really jinxed it. S&P still up, but not nearly as much. We are seeing definitely some selling off since I started this, actually. But that's okay. I could care less what happens in hours and days. We're big long-term investors here. But IYT is interesting because it tracks the Dow Transportation Index, which is 20 companies. Top holdings, FedEx. Obviously, we know what that is, delivery. Norfolk Southern, NSC, which is railroads, UNP, United Pacific Railroad, KSU, Kansas City Railroad, then UPS. Also has JB Hunt, which is trucking, Landstar, LSTR, trucking. And then has some airlines in there as well. It actually has 6 airlines in there. And they're struggling, obviously, the airlines. And it's still breaking out to an all-time high, even with those airlines struggling. That's fantastic. I mean, that just shows how strong it is. And I will tell you, CNBC, Fox, whatever, I hate bashing. I'm sick of bashing them today, but even your financial advisor or anybody, a friend or family member that you might see this week, and they say things are terrible, tell them this, S&P Retail Index, all-time high. Home Builders ETF, all-time high. And transportation doesn't lie, because if the economy sucks, and the economy needs to get much better, and it will. We're rebounding from a horrible shutdown. The transportation stocks cannot do well without a decent economy. It's a great indicator, because you're not shipping things on rail. You're not shipping things via truck. People aren't flying as much, which they're not flying as much. You're not getting as many deliveries, FedEx. It is a true indicator, folks, of the economy. And if it's hitting an all-time high, that tells you something. Stocks are leading indicators. All right, so which one do I have for you here? Well, we bought an airline for some of our Penn Financial clients a few months ago. Still love that one, so I'm not sharing that one. But there's another one here, $2.1 billion, Allegiant Air. I don't know if you've ever flown it. I've flown it a few times. It's definitely low budget. Earnings per share, it's crazy because, what happened last year to now. They made double digits per share last year, looking to lose about $12 per share this year. Obviously, that's pretty easy to understand why. Next year, back to a positive $4 per share, and then 2022, back up to about $10.50 per share, $10.50 per share. By 2023, all the way back to $15.50, better than it was last year. Last year had $1.8 billion in sales revenue. This year, looking to be cut in half, around $985 million, back to 1.8 where we were in a couple years. So, it is what it is with the airlines. Like, Allegiant, I think, is one that, they may nickel and dime you, get you in low price, and it may irritate you, but it's a pretty good business model. Again, I've only flown a few times, so I can't say much about them. But one to keep an eye on. I think this is one that kind of flies under the radar. People look at United, Delta. I think these smaller discount airlines will actually end up doing much better. All right, so I went a long time today. Wow, if I just hit the 44-minute mark. So I apologize for talking so much, but let's just wrap this real quick in 1 minute. We talked about the market. We're still up today, but we're actually getting back a lot of gains. But who cares what happens on one day? I think things look fantastic here. Market pullback right now after running up double digits in about 3 weeks in major indices is normal. do not fret that. Buy into weakness in the quality companies. Second wave of COVID, I don't see it. I don't see it being the same effect on the market. I'm not a doctor. I don't know. I look at the numbers. I see more people flying. I see more people getting out there spending. I don't see the shutdown being the same if we have one, and I don't think we have one. Stimulus, I believe, will get done. Will be a huge catalyst for the market between now and the election. I talked about some stocks, Fastly versus Akamai. We talked about EVs remaining hot, NIO hitting a new all-time high, Workhorse, nice buy and its pullback. We talked about some COVID secondary plays, everything from dry ice to transportation of vials to producers, Lonza. And then we talked about three ETFs hitting highs, retail, transportation, home builders, and 3 stocks in there that keep an eye on. Again, nothing I talk about here is a recommendation. That's just all education for you, and I want you to be educated. Don't forget to like the podcast here on YouTube. Post your comments. Let me know how everything's going. Anything you need to know. We'll do next Tuesday. I'll take your questions on Twitter, Matthew McCall on Twitter, and we'll go through the entire questions. I've been taking questions in a little bit. We'll get to those on Tuesday. Post them on YouTube. I'll take them there as well. Like, subscribe, all that kind of good stuff. Have a wonderful, wonderful weekend. Be safe. Be happy. Go hug someone. Tell them you love them. And we'll be back Tuesday, ready to go. Again, it's been your money line this week on this October of 16th. Man, time flies. And once again, I'm Matt McCall. Thank you so much.
Thanks for listening to Moneyline with Matt McCall. To find more information, head over to McCallMoneyWire.com. That's McCallMoneyWire.com.